Okay, so this is a very warm welcome to the final, I think, session of the day before the prize draw at 4:30. So we're going to keep this session quite short, probably 30 minutes, and we're going to aim to end at about 4:30. We'd love any questions from the audience as we go through, but really, as you can see from the title above us, this session is about how to build your own sustainable portfolio. And what we're going to do is talk to three people who've got huge experience and expertise, and I think really sort of interesting thoughts on the topic of investing sustainably and creating portfolios overall that are sustainable and driving, hopefully, strong sustainability outcomes and impacts, as well as hopefully, again, strong financial outcomes. So with that, I'm going to very quickly introduce, Maria Municchi, who I know very well because I work with her, Adam Harris, who I've just met now, who has got lots of interesting things to say about sort of private market or private asset retail investing, and Nigel Kershaw, who some of you may have seen previously, who is chair of the Big Issue Invest and has been very involved in the Big Issue and its investment arm for many years. So I'm going to start really with a sort of quick fire question of, thank you very much, Lucia, that's super nice. Maybe a quick kind of introduction from each of you, just a tiny bit beyond what I've said, that pulling out a couple of the sort of, let's start with what we do in our individual jobs. Kind of what are the main ways that you would sort of do, you would propose to answer that question, and then we could go into a bit more detail. So a high-level overview of what you do and how you do it would be a great start. And I might start with you, if that's okay, Maria.
Absolutely. Thank you, Ben, and thanks everyone for attending this session. So just to tell you a little bit more about my experience, I've been at M&G for about 13 years now, and I've worked across different asset classes, equities, fixed income, and then more recently on the multi-asset space. So really looking at a variety of asset classes from a global perspective. And within our team, we have developed for more than 20 years an investment philosophy that aims to produce attractive risk-reward type of outcomes from an investment standpoint by utilizing the scale of global multi-asset investing. And about 6 years ago, we started to look at different ways to really integrate sustainability within this existing investment process. And this has been quite a long process with a lot of back and forth, a lot of change and continued evolution of how we're incorporating sustainability, both from a top-down perspective, so how are we thinking about the asset allocation today? How do sustainability trends influence the macroeconomic picture that we're looking at? For example, things like monetary or fiscal policy, or the drives that we see governments putting in towards achieving a more sustainable economy. And then on the other end of the spectrum, really try and select investment that have characteristics of sustainability, being towards climate change mitigation, or more broadly across sustainability as defined by the UN Sustainable Development Goals. So the aim has always been to be able to construct a type of investment that can deliver the needed investment returns, also within specific characteristics in terms of volatility, in terms of risk, depending on the different target client, while at the same time incorporating sustainability really throughout everything that we do and delivering a clear outcome on sustainability, something that investors can actually measure and tangibly see. So this has been a very interesting experience and lead us to what we're doing today across these portfolios. And I think the main, learning point from this will be the importance of making sure that we have a global and diversified opportunity set when we construct portfolios, when we look at how we invest for the longer term, but also at the same time that we're looking at the right type of element when analyzing and defining sustainability as well.
Okay, thanks, Maria. That's a great overview. I might jump to Nigel, if that's okay, to give your take on that question. I mean, you've heard from Maria about constructing the sort of portfolio in a very granular way, covering all asset classes from the bottom up, really. Nigel, what do you do at the big exchange, and what would be your broad take on that? How do you construct a sustainable portfolio?
Well, I'll do as little as possible. No, I'm only joking. I'm a director of the big exchange. I'm the chair of the Big Issue Group, which includes the Big Issue Media, Big Issue Invest, and a joint venture, the Big Exchange. We now manage or advise on around about $500 million of funds, of impact funds. And we really came into the Big Exchange because I'm an pardon me, I've just had some crisps. I'm an ex-printer. I'm not from the financial sector. So I am, in a way, representative of the retail investor. I'm not sophisticated. I think I am now because I've been endued with all these wonderful people. But I think when we first started investing, we were doing direct investments, private equity-like investments into social businesses. And somebody said to me, why can't the ordinary person invest in your funds? And they couldn't because they were limited partnerships and they weren't sophisticated, qualified, etc. So John Bird, the co-founder of the Big Issue, we went down this route of what we called the democratizing of capital. How can the ordinary person build their portfolio? How can the ordinary person get a financial and a people and planet return? So in terms of the building portfolios, we launched the Big Exchange, which now has about 65 impact-rated funds on it from 15, 17 asset managers. And what we did, we built bundles. Because I think a lot of people, maybe not in this room, but a lot of people, actually, they're frightened of building their portfolio and choosing different funds, which you can do on the Big Exchange. So we built these bundles, and what we do is we rate every fund with a medal, a bronze, silver and gold medal, and you have to get that to get on the exchange. So they're all rated, and then we create a low, balanced and higher risk bundles of all the funds, and then and they're rated inside. So we've done it through this bundle route, if you like, and that's how we've done it. So when we're building it, I think the most important thing for us is it's accessible, and I mean by that anybody can do it and that it's fair, and that means it's pricing. Absolutely, it's transparent, so that on the exchange, for example, every single fund exchange gives 100% of its holdings, not just the top 10 or 25. So everybody knows what they're doing when they're building or what the bundle consists of. And the last thing, it's understandable, because I think there is so much jargon, both in the financial world, let alone the ESG world, that actually the simplicity of language is so important. So that's basically how we think about building bundles, building an ESG portfolio.
Perfect. Thanks, Nigel. That's great. And I mean, those are two quite different, well, aligned, I think, but sort of different approaches that professional investors take. Adam, turning these rather bright spotlights onto you for a second. You're a different type of professional investor. You invest as a retail investor for a living. Now, so a different perspective. Could you tell us a little bit of background about what you do, how you do it, and how you embed sustainability into your thinking as an investor?
So it's sort of going in that direction as well and continuing on from that. So I was, this is my second career as well. I was in the film business when the animation industry kicked off with Jurassic Park, and I got in at that point, and that was the birth of it. And then like 10 years later, it was literally starting to collapse under the costs of everything. So you had award-winning films where those companies were going bankrupt because they couldn't survive. So in terms of sustainability, I'm just saying that's kind of where my awareness is. And so I had wanted to, first of all, I had shares in the company, I sold my half, and then I wanted to become sort of financially educated and take control of that. And as to what you were saying with regards to the obfuscation and the language and the lingo and everything, I sort of came from the outside and then tried to learn how to make use of what we do. So I started getting into trading, and so for the benefit, or for the purposes of this, I'm a technical trader. So, which means that I'm predominantly making decisions based off the charts, as opposed to fundamentals. But I'm also very much influenced by Warren Buffett, Ray Dalio, which is Bridgewater Associates, Michael Burry, that you'll know from The Big Short, which was, and who else? But Warren Buffett, Charlie Munger, really very much influenced by them from the perspective of value investing. And so those are, I don't think that those are conflicting ideas. I think that for me, the process, the selection process is easy. So what I mean by that is if a company is stable, its financial records will reflect that. And so I'm sort of shortcutting and I'm sort of cheating, because you'll go through and do all the fundamental analysis and then make those kind of decisions. And I'll be looking at their performance with regards to the stock price. And then I can see their stability based off that history. And then usually I'll be looking for the right kind of opportunity to buy into that. And then, of course, from a risk perspective, I actually wanted to ask you what you define as risk, because I find that quite interesting, because I think other people might want to know, what do you mean when you say risk? So for me, obviously our fear stems from the fact that we might make bad decisions. That's always the case. Now, Buffett, he's always saying, look, diversification doesn't make sense for him because he knows exactly why he is doing every single deal. He knows why he's doing that. Whereas Peter Lynch, One Up on Wall Street, which is a phenomenal book, by the way, to read. There's some really must-reads. Peter Lynch would rather have 1,000 different stocks in his portfolio. And I sort of subscribe more to that idea. I like the idea of a diversification across different sectors, as well as my brother, for example, is all in on Tesla. Like, he's religious and he's all in on it. And I can't shake the feeling that I would just rather not have all my eggs in one basket. And so that's really kind of, so that's my criteria. It's kind of trying to diversify across different sectors, and keeping in mind that sometimes there's a lag between what we think should be. We know, for example, electric cars. We know that that's the way of the future. And yet there's a bit of a lag between the stock prices. And Tesla's a good example as well. Up until December 2019, the stock price was just dead. It was just in a sideways comatose. And then January 2020, it took off. And now everyone talks about it. But Tesla's been around for years. So Buffett's saying there's always two things that impact the stock price. For example, there's the value, the actual value of the company, the profitability of the company, and the public's perception of that brand. And the Tesla's a great example of that, because that is the one thing that can swing the prices wildly. So I tend to look for things that don't do that. And the whole idea, I guess, is buying something that has that sustainable kind of trend. So with regards to the topic today, diversification, I think, is key, and also a bit of flexibility is probably the thing. Is you need some maneuverability, because life is changing really fast these days. And so I don't think you can commit to something for 20 years unless you really know why you're doing that. I think you might have to review things on an annual basis and see if it is still performing the way you would expect it to. Sorry, long answer.
No, that's really interesting. I mean, and I think you're talking about sustainability in a slightly different context generally around the sustainability of the business as opposed to sustainability. But they're clearly linked. I mean, Maria, maybe picking up the question Adam asked you, the question is about, what is risk? How do you see risk? And maybe how do you see risk in a sustainability context? Tesla might be a good example, or thinking about, I don't know, the increasing issuance of green bonds, what are the, how do you think about risk in your portfolio?
And actually, on that note, is it worthwhile talking about what happened with bonds recently with UK gilts and everything, and how that, because most people have no clue as to how that contributed to the mess we're in. So,
and again, Nigel, then maybe you can pick up on the green, the gilts point in a minute. But yeah, Maria, first start with you.
Absolutely. I mean, I think, in investment, risks can, the concept of risk can represent a lot of different things. So it could be, permanent capital loss. It can be just volatility, so short-term movements of the portfolio. It can be a drawdown, so how much portfolios can fall in a period of time. So there's very different ways of talking about risk. The way we've constructed the set of portfolios that we run is they are targeted to specific risk profiles to satisfy different clients' requirements and tolerance for risk, so how risk averse or not they are. But then, we can always talk about risk in the sense of, not being able to achieve the outcome that we put forward for a product, and that could be investment risk, so risk in terms of returns, risk of not achieving the expected returns, but also the risk of not achieving, the sustainability profile that, can be aligned with some investor preferences. And that's very important because I think, any one of us, when we invest, you wouldn't want to invest in something that is completely misaligned with what your beliefs are in terms of, everyday life, and what do you think about sustainability, what do you think about, what could be ethical or not. So I think there is a willingness of having an alignment of these two things. And when you delegate that to an investment manager, we have to be conscious of what's the risk of not being able to achieve the sustainability outcomes. And we try to avoid that by being very diligent on how we assess the companies we invest in, looking at the ESG characteristics, so environmental, social and governance, but also really looking under the bonnet in terms of doing more of the qualitative analysis to try and avoid bad surprises or bad news around particular names, which are then going to also affect the financial outcome of that. So I think having a level of due diligence to ensure that the risks from a sustainability standpoint are as reduced as we possibly can is also very, very important, alongside obviously the investment.
And Maria, just sticking with you for 1 second, what would be, for the audience, a couple of examples of, kind of, in your mind, well-balanced risk opportunities in the sustainability field across the different asset classes that you invest? I mean, is there anything that stands out as both marrying that investment kind of risk opportunity as well as the sustainability outcome?
Yeah, absolutely. I think, we have different type of ways of investing in sustainability. So you could look at companies that have very good ESG characteristics, so they're very well aware of their risks from an ESG perspective, and they have strong policies relatively to that, which should reduce the risk of having an event surprise from a sustainability standpoint. And that should, in a way, maybe think of what you're saying, lead to stocks that are more stable in a sense. But then if we look, further down the spectrum to those investments that might provide solutions towards sustainability, this is a very high growth area. I mean, we have identified, and the world has identified, some very important areas where there are today challenges, both from a social as well as environmental standpoint. And this also creates opportunities because we do need capital in this area to continue to be invested. And this could in turn provide some very good opportunity for growth going forward. I think also if we look at this year, it has been a particularly challenging one from a performance standpoint across asset classes, but also probably in particular on some of those potential high growth investments. So to me, today could be also very interesting time to start looking again and re-engaging with some of those growth stocks as well.
Great. Okay, thanks, Maria. And yeah, Nigel, jump in.
Well, I'm kind of in this middle of the sustainable, because what we're saying on the exchange is we want people to invest in the long term, and I have nothing against traders.
Sure.
But we're not encouraging people that come onto the exchange to trade. We're saying this is long term. And that's, for me, it's the sustainability of a long-term investment in companies and so on, and also the sustainability of this world. And for me, the two go together in a way. Yeah. So it's really interesting because a few years ago, just using examples, in a bond fund that we co-founded, it was riding really high because we didn't have oil. And we didn't have Mercedes or whatever it was in. Right now, everything's swung the other way. So actually the sustainability for us is also about being long-term, exactly as you're saying, sustainable companies in the long term that provide a sustainable return in terms of people and planet. And it's building that together that's the challenge.
And maybe two quick questions following that. One is, how do you, your whole platform is focused on impact and on positive impact, hopefully, and positive sustainability outcomes. Do you find when you analyse all the funds on your platform, are they all leaning in one direction? Are they all performing well, as you say, a couple of years ago and slightly less well now? I totally agree with you. The long-term perspective is absolutely central. And if you're investing in solutions to the world's problems, you've got to take a long-term time horizon. But how do you think about the balance of different types of fund on the platform? Is it about having equity funds and fixed income funds? Is it about, how do you manage the risk on the fund? And I don't want to ask that from a too technical perspective, but just, for those who might be interested in the platform, what's the balance? How do you get the balance?
We do that. We have a company in the City Square Mile do all our analysis. We then we have an independent investment committee chaired by Chris Ralph, who was at St James's CEO, and then we have an impact committee which I chair. And so, because actually this is people's money, that investment committee makes that decision and balances that portfolio, and then we come in and say, well, actually, what is then the overall impact of that bundle or those funds? Or sometimes we might say, actually, that fund can't be in there because of whatever reason. That actually hasn't happened yet, but I'm sure it could happen. But we will go back because it's about the trust of the portfolio, that we don't want to, we've just got to be transparent about its financial return and its impact return.
I just wanted to pick up on something that each of you have mentioned in a way, which is that sort of interlink between business sustainability and environmental and social sustainability. And maybe another way of looking at it is the link between businesses that are or how to measure the success of businesses, whether it's in financial terms or whether it's in social and environmental terms. Are we gradually, given how important these social and environmental issues are we gradually moving towards a world where we might start measuring the social and environmental outcomes as equally important as the financial outcomes? Or do you think the prerogative of delivering good returns to our customers and helping them invest for their future or their retirement, will the financial always supersede the environmental and social? Or are those two things becoming nicely aligned? Adam, what are your thoughts?
Okay, so at the risk of, I'm going to mention something political, and so we'll talk about the US, because the US contributes something like 25% of the world's kind of pollution, and it certainly has a big impact on it. Out of 195 countries, I forget how many we have now, but and so it does it. But the reason I bring this up is that in the US, because they can lobby politicians, the oil and gas industry and the gun industry as well, they are still prevalent because they can lobby politicians. So what's happening there is the tail's wagging the dog. And so in that particular case, in order to make those real important changes that we know we need to be making, so for example, if you obviously could reduce gun deaths, it's like insane the number of shootings. They have like four a day in the US now, one of these kind of things. So in order to do that, they'd have to be able to impact the politicians who then impact the policies. So instead of letting the tail wag the dog. And that's a really, really big thing. So that's where we need to do it. But I do think that the idea of social responsibility has now taken root. So now what's happening is it's not being met with indifference anymore. People are starting to say, listen, what are your goals, or what do you represent? And so yes, I do think that is now kind of it's now part and parcel of everything we do.
Yeah.
But your first and foremost is obviously to deliver a return, a profit to your clients, or to protect their capital, but not a loss.
But you're highlighting the importance of kind of government policy and sort of things like international rules and regulations to drive change, as well as, and it's not just the responsibility of investors.
Yeah, it's money is still a big driving factor.
Yeah.
So my brother-in-law's in Aberdeen and is out of the oil industry, and so yeah, it's interesting because although even in South Africa, for example, BMW was touting the hydrogen kind of hybrid vehicle. This is 20 years ago. They were talking about it, and he just laughed. He said, no, we're not going anywhere for any time soon. And that's because he understood the mechanics of the money behind it. And this is the thing. So when it gets on a really, really big scale, I think that the money makes a lot of the decisions. I do think it's starting to change. I mean, I think we are now not accepting the fact that changes are not being made. And obviously it's dire. We know that the climate is changing. We know all this stuff. And our response, there's a lag. So this is what I was going to say earlier, that there can be a lag between trying to invest into markets that are necessary but very small or in their early stages before we can really see the impact. So ocean cleanup projects and things like that, as an example. I don't know if you necessarily get a good return on that. So sometimes the things that need the money don't get the money, and sometimes that need the investment. So I think it's a process. I mean, like for example now, before Tesla, it's just a coincidence that I'm bringing it up. I'm not trying to tout it or anything. But before Elon Musk, no one was really taking electric cars seriously. They weren't really. And then when he did it, now all of a sudden everybody's like, we've got to do that. So sometimes it does take a bit of pioneering to make that change. Sorry, again, rambling.
I think when you ask me before about government, actually I think one of the things if I want to see is that, for example, why do we, UK taxpayers, finance the national health with kids getting asthma because they're living in a polluted road? Right? So I think bringing in what is the effects that corporates make on our world, in the effect we subsidise. And so I know Ronnie Cohen is doing something with Harvard, which it's an accounting procedure which says actually corporates should use the effect that they're having in their accounting. And so for me, that if it's talking about government, that's how I think sometimes it has to be priced in, because we're effectively subsidising bad behaviour.
Yeah. Exactly. So impact-weighted accounts, that initiative, and really thinking about, £1 million or dollars generated of revenue generated by mining coal should not be treated as $1 million generated by producing a life-saving vaccine. I mean, those are two. One is good for society, the other is not good for society. Just how do you think about that?
I think also, taking a step back and looking, at the investors' behavior and approach to these things, I think there has been for a long time, like a school of thought saying, I'll just maximize all the returns I can get with my savings, regardless of what they do, how they affect society, and then I will invest or I'll donate some to charity to offset that. But I think we're now at a stage where the corporate world is so big, is so important, that there is no way you can in any way offset the damage that might be done and the negative impact that might be done from some of those corporations by your own personal activity or charities, or being a good citizen almost even. So I think there is now a need more than ever to have an alignment of intent between where we invest and what outcomes we want to see in our society. And more we're seeing the industry moving in that direction in terms of being able to provide more data and more visibility about what the negative, as well as hopefully in some cases the positives, effects of investing are in terms of both environmental and social elements of things. And I think we're seeing regulation demanding more and more of that. So in a way, governments are moving in that direction. We're still at a very early stage, but we're starting to see it with SFDR in Europe. More requirements are being made in terms of reporting on these ENS impacts of different funds. And we will be seeing more of that, I think, also here in the UK with the SDR. And I really have, believe that will help also investors to be able to make more, better informed decisions on how to invest, because you have a more clear way of seeing what different investments are doing. Obviously, you won't see it at a single stock, not yet, or at least not as easily, I guess. But you will be able to see in a fund, I think, in 2024. There's still a bit to go, but there will be more transparency in that respect as well.
Okay, that's really helpful. Now, we're just mindful of time, and it's coming up to 4:30. I know we have the great, exciting prize draw somewhere. So I think it's a great conversation. I could happily continue it with you guys for a good another half hour. But I think with a view of maybe wrapping this discussion up for the prize draw, I'd love to ask each of you for a very brief kind of word of advice to the audience about, again, answering the question, if they are thinking about how to build their own sustainable portfolio, what would be your kind of key piece of advice to keep them on the true path and sort of avoid some of the pitfalls that can come down can arise when you're thinking about sustainability? So Nigel, I might start with you. What would be your one piece of advice It can be plugging the platform, or it could be something else. What would you say to the audience?
Well, besides the plug-in platform, which I would plug, obviously, I would say, and assuming that you've looked at the kind of the financial risks, for me, I think the big thing is transparency. Just know what it's doing. It's a bit like Warren Buffett, saying about I want to invest in things that I understand.
Yeah.
Just forget all the green counterfeiting, the social counterfeiting, the passing off. If the corporates or the funds or the bundles aren't transparent, then fine, but transparency for me.
Okay, thanks, Nigel. Adam, your thoughts?
Yes, that's a great, you make a good point there about Buffett's rule of thumb is he has to understand something before he would do it. And so for me as well, the trick in life, especially more now with so much misinformation, that there's a market for misinformation, finding trusted sources is what you really have to invest time in. Once you find somebody whose signal you trust, also listen for the signal, not the noise, and there's a lot of noise these days, but find someone whose opinion you trust. That would be your guide to get you where you are, because it is tough and there's a lot of misinformation out there. It's a problem. So.
Right. Okay, thanks, Adam. And Maria, final word to you.
I'll just give, I think to me, 3 key points. One is the one of clarity, so being clear what your expectations are in terms of returns and risk, but also crucial in terms of sustainability. So what are you ready to accept in terms of sustainability characteristics of the investment you make? What is it that personally you wouldn't want to invest in and you wouldn't feel comfortable? I think that's a question that is crucial to be asked to start with at the beginning of the journey. Secondly will be for me diversification. So I think today there is much more opportunities to be able to diversify an investment that has, a key expectation in terms of returns, but also sustainability. So try and be diversified. And thirdly will be, as has been said, find indicators that for you are relevant, that helps you understanding what the results that has been achieved is, and again, both in terms of financial outcomes and sustainability outcomes.
Brilliant. Okay, thank you all very much. Great discussion. We have got an audience here, so if anyone has a question before we go, please do feel free to put your hand up, or otherwise come and grab the panelists afterwards. But if there aren't any questions now, I'd love to ask you to join me in thanking the panelists for a really good session, and thank you very much, all of you. Fantastic.
Thank you.
Thank you.